That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Nancy Tengler, Laffer Tengler Investments CEO, and Yahoo Finance's Jared Blickery joining us here to break down all the moves today. Jared, my friend, let's start with you on that close.
All right, we got three majors and three record closing highs for them. First up, the Dow, record closing high up 43 basis points, or about almost 200 points there. NASDAQ Composite up about 1/3%, and we'll track the intraday price action. You can see there at end of the day at the highs of the day, and the S&P 500. Fairly similar chart, up 1/4%, and a record high for that as well. And just taking a look at the small caps, S&P 600 was down all day, finished down the day about 85 basis points, or 0.8%. And we already took a look at the bond market, so let's skip ahead to the sector action, and we will see that right here. Here, utilities was the number one returner. It was up about 0.7%, followed by communication services, healthcare, energy, financials, all of those outperforming here on the top row. And then to the downside, materials was the hardest hit, down about 1.6%. Followed by industrials, down 0.7%. And let's take a peek inside the Dow to see where some of the weakness was. Mega caps looking pretty good, except for notably Apple. That was down 1.5% today. And here was the announcement. Here was when the iPhone announcements began. A little bit of green there, but quickly turned into losses here. So a little bit of auspicious announcement day for Apple, though that tends to be the norm. But aside from that, United Health was also an outlier, up 8.72%. Now that stock severely underwater for the year, down 31%, but a nice day for United Health there. Goldman Sachs notably also up 3%. And then turning to the NASDAQ 100, we see Palantir. That's probably close to another record high, if not 114, not a record high, but up 114% for the year. And also taking a look at the mega caps here that we didn't see on the previous screen, Alphabet up 2%, Broadcom down 2.5%, Tesla just barely treading water there to the green side. And I will close here with some of my leaders and sentiment indicators. Up in the left, you can see MJ, that's cannabis, did well today, followed by Chinese tech. Then American tech did well. Korean stocks, that's kind of a proxy for chip stocks. Momentum, Mag 7, IPOs, gambling. So a nice mix at the top. And then to the bottom, solar energy, regional banks, and home builders. Those were the worst off, down 1 to 3%. Josh.
All right, thank you, Jared. Nancy, want to bring you in here, your thoughts on the action today. I got green all over my screen again, Nancy, right? Does the momentum just continue here?
I mean, I hope we get a break, because that's always good for markets. But I've drawn the analogy to the 1990s, and I think we're there. This is a productivity-driven growth environment. Technology is just getting started. We'll hear from Oracle soon. But I do think, you keep hearing, every summer we've heard that the death of technology was imminent, and that's since 2022, and it hasn't been, and we don't think it will be for some time. I was managing money in the 90s. This is much more than that. This is more than eyeballs on a screen. This is, AI, robotics, it's nuclear, it's quantum.
For you, Nancy, then, is it as simple as long as I see the mega AI trade and trend intact, I stay long the market?
Yes, as long as I see it spreading into sectors. And so we listened to the companies. We heard from pharmaceutical companies, retailers, financials, industrials, that they are successfully employing AI to improve margins, to improve supply chain, to lower headcount. And those are things that, while the headcount part might be difficult for some, and I've been there, we all have, it's important because it's going to continue to drive margins, which are at historic highs or near historic highs. We've got free cash flow at corporations at $4 trillion, and that doesn't account for the effects of the recent tax bill, which will contribute another $158 billion to the S&P 400. And then there's the tax refunds that nobody's talking about for individuals. They're expected to increase by $150 billion in 2026 to 520. So those are big numbers. You may have the consumer struggling, and I think we all know that, but the tax refunds will be a powerful contributor to spending.
Now, when I talk to skeptics, Nancy, who sit in that very chair, you won't be surprised to learn that one argument they bring up is valuation.
Yeah.
And they'll say, listen, I get it, it's not a market timing tool, I understand, but we're stretched, and I'm a little nervous about it. Do you share those concerns?
Well, not if you see rates coming down and you see earnings growth doing what they're doing. And I think one of the things that we'll be watching is the ISM manufacturing, which I think is ready to expand. It has done so in post non-recession contractions, and then also in periods where operating earnings are above 10%. We're going to be above 13%. That will be another driver of the market. It doesn't have to just be the Mag 7 all the time. I think what we'll see is a broadening out. We pivoted to housing not too long ago. We own some retailers. We own some of the financials. Goldman's in our 12 best ideas portfolio. So that's what diversification does. But I think it matters which companies you own. It's the management teams.
Final question. Let me ask you, if it wasn't valuation, just big picture, what would be, Nancy, on your kind of radar of concerns?
I mean, if the Trump administration keeps taking ownership in private sector companies. Pet peeve.
You didn't like the Intel stake.
Did not like it. Don't like it.
Are you in Intel, by the way?
No, we were out about 2.5 years ago, thank goodness. But what has the government done? They've diluted shareholders. What am I going to get as a taxpayer? Probably nothing.
Well, here's the argument. I'm interested to actually get your take on this. When you listen to the Trump administration, the argument they put forward was, listen, chips are the backbone of the modern economy now and ahead. This isn't blue jeans. This isn't orange juice. These are strategic assets. This is national security. The U.S. has to stay tip of the spear, and if the U.S. government has to get involved to help that out, so be it.
You provide incentives, though, Josh. You don't take ownership. What's the government going to add? I mean, we heard that with Solyndra in the Obama.
So what about when you hear Trump administration say, "Listen, $10 billion, we need a taste." That's how this works.
Yeah, I think it's. I also heard him say they want to take ownership in defense companies because most of their revenues come from the government. That is not how this works in capitalism. Let the company fail if it must. Somebody will step in and do a better job. Intel's been behind the 8 ball for almost 5 years. They're never going to catch up.
To your point, I would say there are some analysts, here's an argument, who cover Intel, who say, to the extent there's a performance capability gap, their argument was it's actually not about money.
No, it's about lack of industry leadership, innovation, technological prowess. No, this company it reminds me of Xerox. They developed the mouse. Did they monetize it? No. Apple did and Microsoft did. So when you've got a company that's that far behind, who's had no leadership for literally almost 5 years, you have to maybe just say, Chrysler, we bailed them out once, we bailed them out twice, where are they now? They're nowhere. So the government isn't good at this, and that is one of the things.
Winners and losers is your point, yeah.
Yeah, that's one of the things that worries me, especially if they take defense company ownership.
All right, thank you, Nancy. Meanwhile, we move on because the Labor Department revises down nearly 1 million jobs. This is the sharpest adjustment in recent memory. Washington correspondent Ben Werschel joining us now with the very latest. Ben.
Yeah, Josh. So this data revision covers April of last year to March of earlier this year. So about a 1 year span ending in March. And what we thought as of yesterday was that 1.76 million jobs were added during that period. This revision is down 911,000 jobs. So this cuts that right in half and really offers a real different picture of the labor market and how it's been performing over the last year. Basically, the slowdown we've seen this summer clearly has been in progress for longer than this and is a lot earlier. This is also the latest. This is the second year in a row of really outside revisions here to these jobs numbers. It was $818,000 jobs last year, 911 this year. Major changes to the jobs numbers over an annual basis. As the BLS noted in their release, the 10-year average is a 0.2% revision. This one this month is a 0.6% revision. So these are big changes, and I think are going to give folks a lot of questions about the current jobs numbers. This data again only covers through March, but what happens? How do you view current monthly jobs numbers if they're going to change so much in about a year's time?
Yeah, Ben, let's talk politics here for a second. So Trump and his aides, Ben, they've been very out front and vocal about these, large revisions. And you've heard them, Ben, talk about, hey, we need a new approach to data. We need a new methodology. Yeah. Do you think, you see a release like this, do you think that's going to increase those calls?
Yeah, I think it absolutely will increase those calls. And we've seen a lot of political conversation here in Washington today just around this. One quick technical note that I think is important for people to understand is what these revisions are about. I think the way to think about what happened today is a kind of a transition here from softer data to harder data sources. The BLS's job is to give a picture of the U.S. labor market based on all the best information they have. On the month-by-month basis, the best way they have to do it at the moment is surveys, essentially calling businesses and households and trying to create a picture of the job market this way. The big addition to the data this month, and why this changed so much, was tax information, quarterly tax filings for businesses' health insurance. Obviously, if you have numbers there, that's a much more concrete picture of the job market. What it underlines, and what these revisions underline, and this is a point the Trump team makes as well a lot, is that there is clearly a problem here with these surveys. These surveys, if they're going to be revised this much, if they're going to be cut in half a year later, how can we improve that so that we have a better picture in the immediate term? So there's clearly going to be a lot of conversation, and you hear it from Kevin Hassett on Trump's team. The labor secretary has talked about this, that we need to change this survey process. What I will also note is we don't have, and this is another charge you hear coming from the Trump White House, is any evidence of politicization of the data. These are big revisions. These are major changes. There's no evidence that these are being skewed in any way to help a political party. I'll note that the 818,000 revision a year ago, that was very inconvenient for Democrats. That came in the middle of a political season, and the Kamala Harris campaign had a lot of trouble sort of explaining that, and it was very helpful to the Trump team. So there's clearly issues here with the data. There's not evidence of kind of political skewing one way or the other.
All right, Ben, thank you so much. Appreciate it.
Okay.
Well, AI is the talk of the town among tech leaders at the Goldman Sachs Communacopia and Technology Conference. And our very own executive editor, Brian Sozzi, is live in San Francisco with a leader from a key company at the center of that artificial intelligence boom. Sozzi.
All right, thanks so much, Josh. Appreciate it. Here with OpenAI CFO Sarah Friar. Good to see you first and foremost. I think you're the most popular person at this conference, besides me, Sarah.
Just you.
Yeah.
You are it, number one.
You have to be. Are people just following you around, asking you questions about what OpenAI is doing next? I mean, so many investors in this room, and it's just so hard to keep up with the pace of development over at your company.
Yeah, I mean, it is a wild pace that we're on. You're defining a whole new era of AI. What I kind of love is, like, the one thing a conference gives you is a chance to kind of compare and contrast. I think a year ago, a lot of people were still in, it's like, AI real? And I think here we are, a year later, 700 million consumers using the product, 4 million enterprises using it, and I think the value is very real to people.
700 million? Mm-hmm. How fast is the platform growing?
So revenue this year will grow over 3x, so about 13 billion in revenue from about 4 billion last year. So it's tripling on a very big base as well.
So wait, so how much, this year you'll do what, 4 billion, or that was last year?
Last year's 4, this year about 13.
What is it like crunching the numbers for OpenAI?
We use a lot of our own technology to do it. So that is the good news. We're doing it in a very efficient way.
So it's reinvented the finance department?
We are. That is, I kid you not, actually. We use custom GPTs for things like IR. We're using it in our flux, which is a very finance term, but end of the month when you compare what happened to what was supposed to happen, we use a lot of agentic software there. We're using it in areas like procurement, T&E, you name it. We're kind of really trying to create the finance function of the future.
If I'm going to put on my tech vest and pretend I'm an analyst at this Goldman conference.
Yeah, I want to see the bro vest.
Yes. So here's my question for you. Wearing that very fancy vest, where are we at in the investment cycle for AI?
I mean, we are, I might have to use a sports analogy, which is always scary as someone that didn't grow up in this country, but like we're in the first inning. A lot of people have compared the AI era to things like the railway build out, because it is a very capital intensive build out. But I think we are just beginning. We've maybe laid some track from New York to Baltimore, but we're ultimately going to blanket the US and ultimately blanket the world. And so anyone who thinks this cycle is, at a zenith is just, is not seeing what I'm seeing, certainly, which is every day, every week, every month, we are very, very short of compute. It means we can't launch features, we can't train models, we can't give compute to researchers that could have incredible breakthroughs in areas like healthcare and education and science. And so I really am happy to see how much as a country we're coming together to invest, but also just globally how much people are getting that message now.
Will we ever have enough compute?
I mean, I don't know, ever say ever. I'm sure at some point, but in the same way, like, could we ever have enough bandwidth for the internet? Like, could you answer that question today? Probably not. The internet's 2 decades old. So I think it's going to be a long time before we can say, yes, we're done.
How does Stargate play in this?
So Stargate is our term for all of our compute fabric. Think of it as both how we work with third parties, so folks like Microsoft or CoreWeave or Oracle or Google even. But think of it also as our plan for how we will build and design data centers on our own as well, because we think that over the longer run, it will take both first party and third party in order to have enough compute. But also, we are creating a lot of IP, and I want to be able to keep that IP in-house, monetize that IP, and really kind of get the benefit of it. Think of it as kind of Amazon back in the day. If they hadn't created AWS, that would have been a whole massive part of the story that didn't ever manifest. And so at OpenAI, I want to make sure that as we build that full stack, we take advantage of what we're learning, being on the frontier, being the biggest, and learning how to build that well, build that more efficiently, and then take advantage of it in our business model.
When you're modeling out various financial scenarios at OpenAI, do you have the demand it just goes up? When do things flatten down? When do you see that? And are we on the planet when things flatten out?
I mean, when you're at 700 million weeklies, you're starting to talk about, if you looked at our monthlies, you'd be getting close to maybe 20-ish% of the internet population of the world on your platform, right? If you take out, folks that are too young or maybe too old on the other side. But it's only 20%. And we think that this is a technology where everyone benefits. You're getting raw intelligence at your fingertips. And so I would say we're still getting started. And as we build out those models, what gets interesting, it's not just about the user growth, which is tremendous, but it's also about then what are all the areas where we could build products, build business models, and how do those interplay, right? Consumer hardware. Great example, right? We just bought the I/O team, brought Johnny Ive and team into the fold. That could be a whole new business model for us in the same way the iPhone was for the world of mobile.
So you're not launching a phone. Do you want to share what he's actually working on? Do you know?
I have to actually sit on my hands when I talk about it.
But he is working on something. And
I hope he's working very hard on something right now.
Okay. Is that this year a launch for that? Or?
Probably more next year. Hardware has a little bit of a longer gestation period, but we're quite excited. I mean, this technology is multimodal, and I think about the prior era of internet really taught us to look at a screen. If anyone's got kids out there, they know it's hard to get them sometimes off that screen. When you start talking about being able to use voice or listen or use images or video, right, it becomes very, very intuitive and in some ways much more human. But I don't think we yet have the form factor to serve that up.
If you and I are here 1 year from now having this conversation, I hope we are. Mm-hmm. Is OpenAI a public company?
Ooh, that is a good question. It comes back to what do we need to do to build the business? So fundraising is absolutely central to our success.
I can't keep up with your valuations anymore. I've lost track.
We have done a lot of fundraising in the past year. To me, an IPO is just another form of a fundraise. So will we still be fundraising to keep funding compute? I suspect the answer to that is yes. But we'll do it because we see a really strong ROI on the investment into the business with all of the people we're able to serve, going back to our mission, AGI for the benefit of humanity, but also in the products that we're able to create, and then ultimately the ROI that we see on those over a longer term.
Where would you put that being a public company in the priorities for OpenAI?
I will never put being a public company as a priority because I think it's not a destination. It's a milestone on a journey. In the same way I would never put a fundraise as the outcome. Rather, it's thinking more broadly, what does it need to really accelerate this business? And so right now we need money to invest in compute, money to invest in great researchers, and we need to keep bringing customers along by showing them value, whether it's enterprise customers all the way through to small businesses, to consumers, and doing it in a way where we're at the forefront with our models, we're doing it in a very safe way, and that people feel like they're getting to transform their lives.
What do you think about the last valuation I saw on OpenAI, close to $500 billion? I mean, these are very large numbers. What do you think about some of these numbers?
It goes back to where we started. We talked about the revenues. So if you're going from $4 billion to 13, so you're tripling at these real money, right? You're not at 100 million going to whatever 400 million. These are real leaps. Then I start to think about, well, what would the market pay for that in terms of a multiple? It doesn't take that much to kind of project forward $13 billion into 2026, into 27. Remember, it's a recurring revenue business. And then start to put software internet multiples on it. The types of valuations that you're reflecting back at me aren't really that stretched.
Why not
actually.
1 trillion? I mean, the growth rates might be there.
Well, I mean, if I come at it a different way, if you look at this era of computing, right, it spawned the first 4 trillion market cap companies, right, NVIDIA, Microsoft, and so on. We think the AI era is even bigger than all of that. So should it be spawning a bigger than $4 trillion market cap company or companies? Absolutely yes. I certainly hope we're one of them because we are today on the forefront, and I hope we don't squander that lead. I hope we can continue to build on all of the moats that we're putting into the business. And so absolutely, I think you're going to be in trillions of dollars of market cap in this era.
I was trying not to ask you questions about your prior employer. It's just, it's a lot. I haven't seen you in a while. We'll leave it there. OpenAI CFO Sarah Friar, it's good to see you. Thanks for doing this. I know you're in demand. Like, people are probably chase you down right after this set. All right, guys, back to you in New York.
All right, thank you, Sozzi. All right, taking a look now at Oracle as that company reports its first quarter results, and you can see that stock rocketing higher here in the after hours. We're up 20%. Let's get to the numbers. Q1 EPS, $1.47 versus expectations of $1.48. Q1 revenue, $14.93 billion versus $15.03 billion estimate. Q1 cloud infrastructure revenue, $3.3 billion. Here's a number, remaining performance obligations, $455 billion. That was an increase, according to the company, of 359%. Now let's get to the outlook, because that's what I think investors are cued on here and focused on. Oracle sees cloud infrastructure revenue up 77% to $18 billion in 2026. And I'm looking for commentary here from Oracle CEO Safra Catz. She is saying we signed 4 multi-billion-dollar contracts with 3 different customers in Q1. And as for the forecast, she is saying we expect Oracle Cloud Infrastructure revenue, it's going to grow 77% to $18 billion this fiscal year. And then she says it's going to increase to $32 billion, $73 billion, $114 billion, and $144 billion over the subsequent 4 years. She says Oracle is off to what she says is a brilliant start to 2026. This stock was already running hot into this print. It was up about 40% this year. You're up another 21% now in the after hours. Nancy, I got to turn to you. As a shareholder in this one, give me your take on the print.
God, I mean, you don't get this very often, Josh. Thank you. It's the largest holding in our ETF, TGLR. Broadcom was yesterday. Today it's Oracle. And I think you have to think about the company as following a model that Microsoft sort of pioneered. So they went from packaged software to kind of cloud-based. And remember, Larry Ellison was vilified by the marketplace that he missed cloud computing. So for about 5 years, he took out an ad in the Wall Street Journal, bottom right-hand corner once a week, we're cloud computer. Now they've demonstrated it. And I think that as a shareholder, you saw the outlook is what's compelling. I mean, it's not the earnings report. And it rarely has been with them in recent years. It's no longer a CapEx-like company. It's a cap-intensive company. There are rumors they don't have the balance sheet to expand the CapEx. I think they've got the backlog. So we're going to hold on. I mean, if it sold off today, we were going to buy more. But
you would have bought the dip.
We would have bought the dip because we believe in what the company's doing. And I think if you love the hyperscalers, you've got to love this. It's kind of like Broadcom's the poor man's NVIDIA. Oracle's the poor man's Microsoft.
Well, let me ask you about that. When you think of the great cloud computing competition and market, and we think of investors, as you know, that Microsoft, Google, and Amazon, how does Larry and Safra's company fit in there?
Well, they're partnering with these companies. And then if you think about law of big numbers, poor Microsoft's only growing Azure at 30% a year. I mean, you saw these numbers. This is what's going to drive the stock price into the future. And they pay a dividend, and they grow the dividend. So I've owned the company for almost 40 years, and it always paid to own it when Larry was off of the America's Cup sailboat and in the CEO suite. And he's engaged. He's the chief technology officer. So I love it. I'm going to continue to hold it. We're very happy.
That stock's surging 20% in the after hours. Good news for Nancy. Good news for Nancy's clients. More market domination overtime coming right up.